Hey, what's up guys? Welcome back to the channel. Today, I want to share with you the best and most accurate way to analyze a technology company and confirm if it presents a good opportunity for buying or if it could have an embedded problem. So today, I'm gonna talk to you about the free cash flow or FCF. The FCF or free cash flow corresponds to the cash a company generates after accounting for cash outflows to support operations and keep its capital assets. Contrary to earnings or net income, free cash flow is a measure of profitability that doesn't include the non-cash expenses of the income statement and includes the spending on equipment and assets as well as changes in working capital from the balance sheet. Interest payments are excluded from the generally accepted definition of free cash flow. And similar to sales and earnings, free cash flow is often evaluated on a per-share basis to review the effect of dilution. The cash flow available for the company is what we know as FCF, to repay creditors or pay dividends and interest to investors. However, because FCF accounts for investments in property, plant, and equipment, it can be irregular over time. Because FCF considers changes in working capital, it can provide critical insights into the value and the health of the fundamental trends of a company. For example, a decrease in accounts payable could mean that vendors are requiring faster payment, and a contraction in accounts receivable could mean that company is collecting cash from its customers quicker. An increase in inventory could indicate a building stockpile of unsold products. Including working capital in a measure of profitability provides an insight that is missing from the income statement. Now, imagine a company has an EBITDA of $1 million in a given year, and that this company has had no changes in working capital, but they bought new equipment worth $700,000 at the end of the year. The expense of the new equipment will be spread over time by depreciation on the income statement, which evens out the impact on earnings. However, because FCF accounts for the cash spent on new equipment in the current year, the company will report $300,000 of FCF on $1 million EBITDA that year. If we assume that everything else continues the same and there are no further equipment acquisition, EBITDA and FCF will be equal again next year. In this situation, an investor will have to do the research over why the FCF dipped so quickly one year only to return to previous levels. While FCF is a useful tool, it is not subject to the same financial disclosure requirements as other line items in the financial statements. This is unfortunate because if you adjust for the fact that capital expenditures, or CapEx, can make the metric a little lumpy, FCF is a good double check on a company's reported profitability. Although the effort is worth it, not all investors have the background knowledge or the willing to dedicate the time to calculate the number manually. Consider the following example. What would you conclude about a stock's likely price trend with diverging fundamental performance? Based on this trend, an investor will be on alert that something may not be going well with the company, but that the issues have not made it to the so-called headline numbers, or EPS. What will cause these issues? Well, investing in growth. A company could have divergent trends like this because management is investing in property, plant, and equipment to grow the business. In the previous example, an investor could detect that this is the case by looking to see if CapEx growed between 2016 and 2018. If FCF plus CapEx were still upwardly trending, this scenario could be a good thing for the stock's value. Stockpile Inventory. Let's take the example of Decker's Outdoor Corp, DEC, famous for their UGG boots, which between 2015 and 2016 grew sales by a little more than 3%. However, inventory grew by more than 26%, which caused FCF to fall that year even though revenue was rising. Using this information, an investor may have wanted to investigate whether DEC will be able to resolve their inventory issues, or if the UGG boot was simply falling out of fashion, before making an investment with the potential for extra risk. Credit problems. A change in working capital can be caused by inventory fluctuations or by a shift in accounts payable and receivable. If a company's sales are struggling, so they extend more generous payment terms to their clients, accounts receivable will rise, which may account for a negative adjustment to FCF. Alternatively, perhaps a company's supplier are not willing to extend credit as generously and now require faster payment. That will reduce accounts payable, which is also a negative adjustment to the FCF. From 2009 through 2015, many solar companies were dealing with this exact kind of credit problem. Sales and income could be inflated by offering more generous terms to clients. However, because this issue was widely known in the industry, suppliers were less willing to extend terms and wanted to be paid by solar companies faster. In this situation, the divergence between fundamental trends was apparent in the FCF analysis, but not immediately obvious by just examining the income statement alone. So that's it for today, guys. Thank you so much for watching. I really hope you enjoyed the video and helped you to understand everything about the free cash flow. If there's anything you would like me to extend on or any other topic that you would like me to talk about, please leave it in the comments. Safe investments and see you in a couple of days.